Welcome to chapter 2, and in this chapter we'll be discussing about financial markets and institutions. Per se, we'll be discussing more about how money flows in the economy, and that's very integral to understanding of finance because economy depends on a strong financial system. And history has shown that a strong financial system is a necessary ingredient for a growing and prospering economy. And this has been true for the U.S. Economy for a pretty long time. You must have seen the growth of new companies that have come up in last 2 decades. For example, the case of Apple, Microsoft, Facebook, Google. All these companies have come in last 20 to 30 years. And the fact that these companies have grown exponentially is because money has flown from savers onto the business or the borrowers, and that has been the hallmark of the U.S. economy, where this interaction between the borrowers and the savers happen, and then we have these strong financial institutions. You can call them the examples of the stock market, the bond market, or the banking channels, some of the investment banking channels, the hedge funds. All these, allow for the flow of funds or the flow of the economic activity by involving the borrowers and savers. So when I talk about borrowers and savers, we have an example here, a diagram of capital formation process for business, and this capital formation process that we have is per se looking at in the economy. So the savers can be individuals. For example, when we have a bank account open and we save money in a bank account, then we are savers. Now, savers can also be businesses because a lot of businesses have surplus cash in hand. What do they do with that? I mean, not all of the money that businesses earn or have earned in profits is distributed among shareholders as dividends. Some of it is basically taken and saved up as cash reserves. So such businesses would, take the money that they have saved up as cash in hand and, normally invest in very liquid investments. And we'll be discussing more about these financial jargons in chapter to follow. But just to make it very simple, savers can be anyone who's saving money, and that money is basically put into some sort of financial institution who then can channelize it for businesses or borrowers. Now again, on the other end are businesses and could be typically borrowers. For example, individuals are borrowers as well. When we take out a loan for purchasing an automobile, that basically is a loan for a car, and that is borrowing. Then you also have the case of borrowing for home purchase, normally known as a mortgage. There could be businesses borrowing for their capital projects, which is long-term or short-term, and they basically, issue notes. And again, we'll be discussing about all these specific aspects a little later today, and also in chapters to follow. Governments, they are a very heavy borrower. A lot of projects that are initiated in the economy, it can run into billions of dollars, and that is normally financed through issuing of bonds through, again, financial institutions. So you have, these examples that I just gave could be normally the case of a direct transfer where savers are providing dollars directly to businesses, And in turn, the businesses would directly issue securities, which would be in form of stocks or bonds, over to the savers. And vice versa, as for example, any dividends that have to be paid out, then businesses would again, pay out to the savers, or any coupon payment which are related to the bonds have to be paid out again. Businesses will be paying out to the savers. And once the maturity of normally the bonds completes, that is, the term has completed, then the principal amount is again paid out by businesses to savers. That is returning the funds that were originally loaned out by savers. So that is the normal route of transfer of funds. And again, that's critical because imagine if, for example, Apple, when it was growing, needed funds to grow, and it had no funds to grow. What would have happened? Obviously, we wouldn't have had a case as the like of Apple today, because it would have just remained as a very small company because it doesn't have funds to grow. Same case for Google or Microsoft or any of these new firms that you have seen, Facebook, LinkedIn, and so forth. All firms, as they expand, they need capital infusion for growth purposes. For example, they have to expand. They are moving out to new markets. They're expanding to, catering to millions of customers now. So they need new hardware. They need new programmers. They need new office space. They may need new places of operations as they expand to other countries, where again they may be hiring accountants, lawyers, public relations staff, and so forth. Where are the funds going to come from? That is going to come from actually the savers who are providing funds to businesses on stated terms. Now, there could also be the case of indirect transfer. Now, again, it will become self-evident, as I explained, that why do we need to have intermediary in certain instances. So, for example, in this case, it's again the savers who are providing dollars, but then they're providing dollars to an intermediary, which is sort of a middleman or a middle person, you can say. And this intermediary would then repackage based on the needs of the business to provide funds to them. For example, as a saver, I might have a saving strength of maybe a couple of $1,000, which I'll deposit in my bank, or any amount that I deposit may be for a period of, let's say, a couple of months or up to a year, because then I would need funds. That may be the case for me. On the other hand, the business, for example, may require $1 million, I'm just making it up, and for a period of 10 years because of the project. So how would then the saving targets of a saver be matched with business? Because now the business wants funds for a longer term, for a longer amount, a bigger amount. What the investment bank does is it is now collecting funds from not just one saver, but hundreds of thousands or even sometimes hundreds of thousands of savers. And all the fund that is deposited, they're able to repackage based on the requirements of the business and be able to provide dollars to them. Obviously, why would investment bank be doing such a worthy service? For commission or for the interest rate spread, which we'll discuss later on. That is simply the difference at which the investment bank would pay out to the saver in terms of interest rate, maybe a little bit less, let's say 3%, and then the loans that they make out to business could be a little bit more, let's say at 4%. So the difference between 4 and 3 is the interest rate spread. That is 1% difference, and that is you can call it profit, you can call it service charge, you can call it any sort of a revenue stream for this investment bank that they are able to operate upon. So likewise, the transfer again is indirect. For example, in a case where investment bank is collecting funds for securities, the securities are transferred to investment bank and then over to the savers. Or if it's a bank, then simply it's just collecting funds from savers, transferred over to business, and then business would be providing those periodic payments, interest charges and so forth, and that again is transferred over to the savers in periodic payments. Now we also have a case of indirect transfers through a financial intermediary, which could be again a financial institution that is now again acting as a liaison between the savers and the business. So you could have any number of ways that you can package the funds or the securities, and then this highlights the importance of financial intermediary. Or if it's a case of simple fund transfer, you could have investment bank. So in this slide, what we are seeing is S&P 500, which is sort of an index of, you can think of it as a proxy for the overall stock market, and that is giving you S&P 500 index total returns, dividends plus capital gain or loss. Now dividends obviously is a share in profit that the companies make and they decide to share with its shareholders. Capital gain is the growth in the actual value of the stock. So for example, if you purchase a stock for $10, and if today the value is $12, then the $2 growth is capital gain. And let's say the company decided to give $1 dividend, then your total return is going to be 2 plus 1, that is $3, because you have $2 coming from capital gain and $1 coming from dividend. Now in certain instances, you can also have a capital loss. For example, you purchase a stock at $10, and because of any number of reasons, it's trading at $7 today. If you decide to sell it, and you do sell it, you have a loss of $3. So that is your capital loss of $3. In this case, if the company had still decided to give out a dividend of $1, your total return would have been $1 minus 3, which is going to be negative 2. That is minus $2 on this investment. The return, and that is how you calculate, the dividend yield, which is basically the dividend that's paid out divided by the price of the stock, and capital gain, as I just showed you, is the profit or loss that you made on the stock divided by its price. And we'll be discussing this in detail when we come to the chapter on the stock prices or the actual calculations. But today, just kind of remember how or what these concepts are. So this is what a typical stock quote will look like, and this is an example of Facebook Incorporated, and a couple of things that you need to look at for a stock quote, and I'll show you also, how to search for a stock quote. But typical things that you need to look out for a stock quote, obviously starting out is the name of the company, where it's Facebook Inc., and this FP is the ticker symbol. You must have seen in some of the financial news channels a strip below or above the newscaster or somebody who's presenting, and it basically has some information just scrolling across. Just to make it simple, the entire name of the company is not mentioned. It's just FB, which is Facebook. It sort of is an acronym by which the company would be standardizedly known to all investors or market participants, so that you're not taking a lot of space, because there are going to be several companies and a lot of information has to pass through. Just to make information go through quicker, this ticker symbol is a nice way. Just to say, for example, you have your first name and last name or a middle name, and then you have a social security number or an ID number. So you can think of this FB to be the ID number of the firm. Now, NASDAQ general stock, that is where the stock is listed. This is an exchange, and it's NASDAQ. GS refers to general stock. So this bold number 29.03 is the price of the stock at which Facebook is trading right now, or the last trade, which would be $0.71 more than the last trade, because remember, every time this number fluctuates, it reflects the price at which the Facebook stock was purchased or sold last. So basically, right now it's 29.03. That is the price at which it traded immediately, and 0.71 is reflected that it was $0.71 more than the previous trade, which is 2.5% more. Now, this is the time at which this price is reflected at, 29.03, which is 3 p.m. Eastern time, because NASDAQ is situated in New York City, so basically it's quoted in Eastern time. So previous close is the price at which Facebook traded yesterday, that is, or the last it traded at the previous date. So for example, if it's a weekend, then that would have been Friday evening. If it is, let's say, Tuesday, then this reflects the price at which Facebook closed on Monday evening. So open is the price at which the stock opened this morning. And if something, if you could basically observe, there's a slight difference between the close and open. And you'd be wondering, how come it closed at $28.32 and it opened at $28.19? And it's the simple reason that even though the stock exchange, even though NASDAQ is an all-electronic exchange, even though the exchange has shut down for operational purposes, but since it's a dealer network connected system, the trading is still taking place. There's still buying and selling happening. The only thing is, it's in the morning that all these after-hour trades get settled, and that is reflecting in this open price, which is a little bit different than the closing price. Now, bid is the price at which the dealer, the party who's buying or selling, normally I'll explain the concept of dealer. This is the price at which the dealer is willing to buy the stock. Bid, like you said, bidding, so the dealer is saying, okay, I'll buy the stock at $29.03, and this is for a block of 4,000 shares. Now, ask is the price at which the dealer is willing to sell. And again, it's at $29.04 multiplied by 4,500, that is in the block of 4,500 shares. So this is the block meaning for how many shares. This quote is valid for how many shares. Now, if you can see that there's again a minute difference between the bid-ask, and that's called the bid-ask spread. And I'll explain what that is. So basically, you can see that the dealer is willing to purchase at $29.03 and willing to sell at $29.04. So the bid-ask spread, as I explained before, is a difference. So you can see that difference here of 1 cent. That is dealer profit. So the spread is, basically the dealer also has to get funds for its operations. People it's hired. They have to pay the seat fee. That is, the right to trade and become a dealer. All those expenses are met through this bid-ask spread, which is dealer profit. Now, 1 year target estimate is the estimated price at which the stock, is estimated to be at by analysts. So analysts are making a prediction that it will be coming to $33.59 in 1 year. Beta, you can think of it as proximity to overall market. So basically, what is the likelihood of the stock moving with the overall market in the same direction? It is 1.702. And again, this is a concept we'll be discussing in detail in chapters to follow. But think of it as anything which is 1 is basically saying if the market is going up by 3%, the likelihood that this stock will also go up by 3% is 100%, because it's coming exactly 1, which is 100%. So 1.702 means that it is even going to go even more further up in the same direction, in proximity to the market. So it's very likely when the market is going up that Facebook stock will go up, and vice versa. If market goes down, overall market goes down, then Facebook stock will also go down, because it's so highly you can say correlated with overall market stock. And we'll again right now just think about this as a conceptual understanding. Don't get confused, or don't just try to get the details per se. We'll be discussing these into how to calculate beta when we come to the chapter on stock market. Right now, just focus on these basic terminologies. Next earning date is basically when earnings for this company is going to be announced to public, because it's a publicly listed company. Right now, it's not applicable. They don't are. Basically, it's not available, that information. Days range, the high and the low at which the stock traded for today. The highest was $28.12, and the lowest is $29. And I'm sorry, the lowest was $28.12, and the highest was $29.08. So basically, it opened at $28.19, so it did go up a little bit above the opening price, but at the time the market closed, it settled into a price lower than it opened that morning. 52-week range, that's last 1 year. The lowest the stock was at $17.55. The highest was at $45. So it gives you sort of a benchmark as to where today's current price is in reference to this range. Volume is the number of stocks that have been traded today. So basically today 33,729,430 stocks of Facebook were bought or sold. And volume, what that does is, again, has to be looked into the reference of an average volume of last 3 months, and that's 68,521,900. Now, Normally, the trade should be somewhere around the average volume. If it is drastically over or above, then there's something which is going on with the company. So for example, if it goes way above this average, then you can say, well, either some good news has happened or bad news, because volume, if it's, let's say, 100 million compared to 68, that's average, then you might be wondering what's good that happened about Facebook, because now suddenly people have started buying Facebook stock, or maybe something wrong might have happened with the company and people are suddenly selling. But again, trade has to happen with buying and selling. So one has to buy, one has to sell. So either way, you have to look that in as a benchmark, looking at the average and seeing what today's volume has been compared to that average volume. Market cap is the market capitalization, which is a market-based value of the company, the entire firm, which is at 69.17 billion. Now, that is easily calculated by taking the price of one stock multiplied with all the stocks outstanding in the market. So it's like you have a pizza with 1, 2, 3, 4, 5, 6, 7, 8. Yes, 8. So if I know price of one slice, then I can calculate the price of the entire pizza, because each slices are identical, and then price of each slice is going to be the same. So all I need to do is, if I know, let's say $1 is price of one slice, just multiply 1 with 8, and that's going to be the price of entire or complete pizza. That's $8. Same concept applies for shares. Each share is identical in its pricing. Each share is identical in its characteristic. I'm talking about the general share, not this preferred class we'll talk about later on. So all you do is to get the market capitalization is look at the price of one share, multiply with all the shares outstanding in the market for that firm, you get market capitalization. Price earning is a ratio. So for example, the price of the company in terms of the stock divided by its earning. So basically it gives you a reference as to how much price in terms of dollar are you willing to pay for every dollar earned by the firm. So basically this is a ratio, and it will become evident when we talk about ratio analysis in chapters to follow. Earnings per share is the total earning of the firm divided by all the shares outstanding. That's 0.02, so 2 cents per share. And again, if you wanted to calculate price earning, all you do is take 29.03 and divide by 0.02, and that will give you price earning figure that's here. Dividend yield is not applicable. Maybe no dividend has been paid out because the earnings have been so low. So dividend and yield is difficult to calculate because no dividend, there may not be any data for dividends that's been paid out. So as you can see, the other thing that's available here is a chart graphical representation of how the stock has behaved or fared in today. And then you can toggle between last 1 day, 3 day, 1 month, 3 months, and 6 months and 1 year. And that basically is the way you read a stock quote. Now, many websites give you this information. Let me just see if I can pull up and show you. So now you should be able to view the browser window, and So I'm going to site finance.yahoo.com, and we'll be looking at the site for a lot of things. So you may want to just experiment, play around with this website. You can even go to other sites like Bloomberg has it. Pretty much, the data is going to be similar. And this again site gives you a lot of information which is related to business, finance, economy, and so forth. For example, if you just want to get information on Facebook today, so all I need to do is just look at FB, the acronym, the ticker, and see how it pops up, Facebook. I can click, and there you go. So the example that was on the slide was obviously several years ago data, and this is today. And you can see that the Facebook has done very well in the last couple of years because the price today, or the closing price today, is $150.04. In fact, you can see that this is $1.74 over than it had last traded. So, like I said, you can even look at the 5-day, see how the graph has changed. This is last 5 days. Then you can look at last 1 month, and you can see last 6 months. And last 6 months actually is in the red. For example, the price on June 24, 2018 was $214.67, and today it is $150.04. So for example, if I purchase the stock 6 months ago at $210.91 and I decide to sell today at $150.04, then obviously it's a capital loss because I bought at a higher price and I'm selling at a lower price, so that's going to be a capital loss. Looking at 1 year, again, it's a big red. 5 years, it's still green. So for example, if I purchased the stock way back in 2014, February 1st, 2014, decided to sell today, yes, there were some drops, but that's a good capital gain. I mean, it's almost double. I doubled my funds if I had done that. So it also depends on, the horizon or the period between which you're trying to do the calculation. So try to, experiment, try to just play around with this site, and you'll get to have a lot of information. Also, you can compare between companies. So for example, this is Facebook. If I look for, let's say, Google, and remember, Google had changed its name, so basically previously it was known as Google for trading, for other purposes, but now it changed its name to Alphabet Inc. So you can see this is Alphabet, and Google is listed at 1098.26. So it's done very well. A good thing about Google and these firms is the fact that they are all trading on NASDAQ. Now, NASDAQ is, if you search for NASDAQ and you go to their website, you find that most firms which are trading on NASDAQ are tech, financials, or new sector firms. And it's a very interesting story because when all these new firms, for example, Yahoo, Microsoft, Apple, they wanted to get onto being listed on a stock exchange, they found it very difficult to get listed on the traditional New York Stock Exchange because there were more traditional firms who had much higher net worth, and in terms of market capitalization. And these firms couldn't meet the stringent standards for listing, the rules. So NASDAQ was very accommodating. They said, okay, you come over to us and we'll help you list, which ultimately paid, because all these stock exchanges, the way they make money is the commission that they get or from other operations that they receive when stocks are bought or sold. So obviously tech firms, financials, new sector firms in medical, pharmaceutical, and biotechnology, their volume is much more than traditional firms in manufacturing. For example, Ford, GM, and so forth. And so let's take an example, let's say for Ford. Ford, the car manufacturer, and you can see Ford's acronym or ticker is F, simply just F. If I click on it, and you can see that Ford is listed on New York Stock Exchange. Compared to any of these tech firms, look at the price, $8.58. And you think with the kind of infrastructure, the work that Ford does, it's a historic firm, has operations typically in many countries of the world, and still its market capitalization is less than all these technology firms. For example, Apple and Amazon only last year became the first firms ever to cross $1 trillion mark in terms of market capitalization. That's a lot of money. I mean, $1 trillion, we're talking about 1/14th or 1/15th of the entire US GDP. That's a lot of money. I mean, some countries, many countries in the world, don't have a GDP that crosses $1 trillion. So you can think the kind of size and the power, financial power, of course, and even influence that these firms have. And so most businesses which are now moving towards these new sector businesses are making a lot of money. So let's look at a summary of major market instruments and security characteristics. So starting with corporate bonds, it's a capital market, and again, just to give you a reference, there are two types of markets or market classification based on the time horizon of the instrument. So if you have instrument which is being traded for or having a maturity of 1 year or less, that is referred to as money market instrument. And if you have an instrument which has a maturity of 1 year or more, or over 1 year, that is classified as capital market instrument. So by the name of it, capital projects are normally long-term projects, and thereby it's going to be a capital instrument. Money markets are normally short-term, and they're required for short-term purposes. So these instruments are called short-term. So corporate bonds are issued by corporations held by individuals and institutional investors. They're riskier than the U.S. government securities, but less risky than preferred and common stocks. Varying degree of risk within the bond depends on strength of the issuer. So what that means is, let me just so basically, if I were to show you a very simple chart, and this is reflecting the relationship expected return and risk between various securities, it can be drawn out as a linear relationship. So basically, higher the risk you're willing to take, it results in a higher expected return. I mean, it's expected. Again, this is not guaranteed, it's expected. So it starts a little bit over zero, you can see that I didn't start from zero because this little bit over zero is the starting point, which is the risk-free rate. That is the rate you would be assured or can expect to receive by taking zero risk. Now, what is that zero risk? This is the U.S. Treasury bonds, basically because backed by the U.S. Treasury, and this is pretty much saying it's a proxy of zero risk. That is the only condition or only way that this security backed by the U.S. Treasury is going to fail or will not be able to provide its contractual obligations is if the U.S. Treasury were to fail, i.e. the U.S. government were to fail or default on its promise. And the risk of that happening is very low. That's why it's called risk-free rate. So moving on, if we're looking at corporate bond, it's going to be a little bit over. So basically, you start with risk-free rate, which is U.S. Treasury notes, and then you can come to municipal or other government-issued bonds, and then you come to these corporate bonds, which have a little bit more risk, but they provide you with a little bit more return. Now, why is corporate bonds more than riskier than government bonds? Well, in case the corporation that's issued the bonds files for bankruptcy, then in that case, yes, the bonds may or may not be able to fulfill the contractual obligations. We had the case of that happening in the recent financial crisis where GM basically defaulted because of its not being able to fulfill the contractual obligations on the coupon payments of the bond, and thereby investors had to renegotiate the bond terms where basically they were only offered pennies on the dollar. A lot of money lost, a lot of people, investors lost a lot of money. That's why it's riskier than the U.S. government securities, and it depends largely on the strength of the issuer. Now, original maturity can be up to 40 years, and why again people would invest in a security that's of 40-year length or typically 10, 15 year, because it's a fixed income. And we'll discuss about that in the bond chapter, but fixed income meaning the corporation is going to be paying out a fixed amount of money that is compensation for the money that you have given out to the firm, and in turn they have given you the bond, so they have to fulfill the contractual obligation by giving you coupon payment that is fixed amount at fixed interval. Typical interest rates, and they are assessed by the riskiness. So AAA means that it's highly likely that the bond will fail. BB has, again, it's a notch down, so there is some element of risk. So you can see that a bond which is AAA, which has very little chance of defaulting, will pay out a little bit less interest than a bond which has a little bit higher risk. So this is like credit score. A person who has higher credit score will be offered loan at a lower interest rate. Person who has a little bit more, a little bit less credit score, higher risk, will be offered loan at a higher interest rate. So that is exactly the same concept that applies even to firms or governments will realize. So how the financial markets work out for individual is no different than how it works out for companies or even governments. For example, in international markets, sovereign funds, basically, if U.S. were to go out and sell its bonds in the U.S. Treasury sells its bonds in the international markets, they will be ready buyers because U.S. has never defaulted on its bonds, so it has a very high credit score. Whereas, and no disrespect to any emerging markets, for example, if they were to go out to raise funds, they might have some difficulty and they would have to offer a little bit higher interest or coupon payment per se on bond to be able to raise funds. Leases, these are capital similar to debt that firms can lease assets rather than borrow and then buy the assets back. So it's typically an example of how firms are able to raise funds. Risk is similar to corporate bonds, generally lease for 3 to 20 years, and interest rates are similar to bond yields. Now again, we'll talk about the technical difference between a yield or interest or coupon payout. Yield is a term that normally functions on the coupon payment, the periodic payment that's been made, divided by the current price of the security instrument. That is how you calculate a yield. Preferred stock is a capital instrument issued by corporations to individuals and institutional investors. Generally riskier than corporate bonds, but less risky than common stock. Now, common stock, as I had started drawing out in the risk-return relationship, so there you go. So common stock is going to be somewhere here. It's pretty risky. And then you have risk-free rate. You have these government bonds, municipal bonds. You've got corporate bonds, and then there could be leases. Then comes preferred stock, which is sort of a hybrid between common stock and the bonds. So that's why they are not as risky, and they don't get as much of interest rate or yield as or return as in case of a stock. So interest rate could be between 5.5 to 9%. Common stock interest rate is not applicable. Why? Because common stock, you are an owner of the firm. You don't collect interest on your own investment. What you get is dividend, that is share of the profit that the firm makes, and also the equity that you build up. That is your reward as an owner of the firm. So the reason that you have interest rate for preferred stock is because it's a hybrid between common stock and corporate bond. So it's got some elements of corporate bonds and some elements of the stock. And again, not to kind of go very much into detail, because these are the aspects that we'll be discussing in detail in chapters to follow. Just think that in case of preferred stock, you are given a coupon payment, which makes it like a bond. But if a company does not make any profit, it may decide not to share the bond, a coupon, a feature coming from common stock. So next we come to those other instruments. So this is the proxy for the risk-free rate, the U.S. Treasury bill, and it's a money market. So all these are money market, which up to here. This is money market. So their duration is going to be up to 1 year. So you can see all of the money market instruments are up to 1 year. And then capital markets are all going over 1 year. So U.S. Treasury bill, it's a money market sold by U.S. Treasury to finance federal expenditure. Again, for short term, not for long term. These are to fill out short term needs. And also, when you read through some of the money and banking and economics concepts, you soon learn that these U.S. Treasury bills are a tool by which the U.S. Treasury enacts, the Federal Reserve enacts the monetary policy, that is to influence the market interest rate and flow of money in the economy. they're default free, like I had mentioned, and close to riskless. That's why it's called risk-free rate. So anytime a job interview or you refer to a question saying, what's a proxy for risk-free rate, you can always say it's US Treasury bill. So you can see that the kind of interest rate that you get is pretty low. Why? Because it's almost zero risk. Bankers' acceptances is a firm's note, but one guaranteed by a bank. So it works really well between trading partners, where one company has to order the other company, wants assurance that yes, we will begin manufacturing. Maybe it's a big order, and they need some assurance. So that could come through bankers' acceptance. Commercial paper issued by financially secure firms to large investors, and these could be bearer or non-bearer. For example, bearer are the ones where name of the buyer is inscribed. Non-bearer is the one where the name of the buyer is not inscribed. It could be simply traded in the secondary market like any other security instrument without the name. So a lot of the fact that it doesn't have a name, it makes it very liquid. That is, the buying and selling is very easy, because if you have a name, then the legal aspect about buying and selling delays the process of actually selling. But when you have simply a handing over, because it doesn't have a name, it doesn't require too much of time and legality. That's why there's a lot of concern about commercial papers in international markets, because this could also be a concern when you're trying to track, illegal funding, for example, for political reasons or for terrorist activities or drugs and so forth. The negotiable certificate of deposits issued by major money-centric commercial banks to large investors. Default risk depends on strength of the issuing bank, and it's up to a year. So, for example, if the likes of Google, Facebook, they've got $200 billion in cash reserves. What do they do with that kind of money? They might have a bank issue them a negotiable certificate of deposit, where they can decide on the kind of interest rates they'll earn. Money market mutual funds invest in T-bills, CDs, commercial papers held by individuals and businesses. They have low degree of risk, no specific maturity. It has instant liquidity. That is, you could instantly go out and you could liquid your investment. Liquid, again, selling. That's why it's liquid, like water. Again, interest rate is low. So a characteristic that you'd soon find out for money market is, A, it's highly liquid, so the buying and selling doesn't require too much of time and effort, and consequently, because of the lower risk, because it doesn't have the risk associated with liquidity or the time maturity and so forth, the returns are fairly low. Euro-dollar market time deposits issued by banks outside the U.S. Default risk depends on strength of the issuing bank, and it's up to 1 year. Now, one aspect of euro-dollar is that it's the trading of dollars outside the U.S. markets or the U.S. territory. So what could be, a potential risk of that? Because remember, the Federal Reserve, which is the central bank of the U.S., is overseeing banking operations within the United States. So all these operations that are happening, even with the dollar outside the U.S., is not under the purview of the Federal Reserve. So anyone who's conducting a transaction outside the U.S. in dollars obviously is taking a lot more higher risk, and thereby is going to demand a little bit more in interest rate. Consumer credit, including credit card debt issued by banks, credit unions, and finance companies to individuals. So it's like credit cards. Risk is variable depending on the credit score of the person. Original maturity is variable. Interest rate is variable. APR is typically between 10.91 to 16.36%. U.S. Treasury notes and bonds. Now, bonds again is going to be a capital market because it's going to be more than 1 year. Notes are typically, a shorter duration. Issued by U.S. government, it could be between 2 to 30 years, and typically, these are the interest rates. Mortgages, again, it's a capital instrument because normally you take out mortgage for, time frame of 15 to 30 years. Loans to individuals and business secured by real estate. So your actual physical property is lien on that mortgage until you clear that mortgage. Risk is variable. Risk is high in the case of subprime loans, which are issued to borrowers who don't have perfect, or good credit score. So the interest rates can be pretty high. They can be, like I said, typically 15-year or 30-year loans, and you have these rates fluctuating quite a bit. Right now, you could expect to pay almost around 4.5% APR on a 30-year mortgage, again depending on what sort of credit score. State and local government bonds, capital instruments issued by state and local governments, held by individuals and institutional investors. It's riskier than the U.S. government, but exempt from most taxes. Most of the municipal bonds typically are exempt from the federal taxes. So the interest that's earned or the coupon payment that is made and you earn on municipal bond is exempt from you pay federal taxes, and that makes it a little bit more interesting for individuals to invest in municipal bonds. Original maturity can be up to 30 years, and these are typical interest rates. Now, unlike what you might sort of perceive, and most people might think that yes, this is going to be risk-free because it's issued by a municipality. But again, remember, sometimes municipalities also file for bankruptcy. There was a case of City of Detroit filing for bankruptcy protection, and most of the bonds that they had issued out had to be renegotiated by the city with the investors. So 10 largest hedge funds as of January 2013. We'll discuss about these in detail, but just to give you some idea on how various these investments hold. For example, Bridgewater Associates has $83.30 billion under their management, and so forth. And we can have JP Morgan Asset Management is second at 54.8, and so forth. U.S. banking holding companies, JP Morgan Chase and Company. Now remember, when you say bank holding companies, that means it is holding the bank or bank associates and maybe some other operations. So it's just not a typical fund accepting institution. It could be, holding other, for example, a brokerage firm, could be insurance, could be other type of investment firm and so forth. So like, for example, JP Morgan Chase and Company, Bank of America Corporation, Citigroup, Wells Fargo, Goldman Sachs, MetLife, Morgan Stanley, US Bancorp, Bank of New York Mellon Corporation, HSBC North America Holding. That's all in panel A. And then we got panel B, which has the likes of Deutsche Bank, BNP Paribas, and so forth. So you can see that while U.S. banks have grown dramatically as a result of recent mergers, they are still small by global standards. Panel C of table, lists 10 leading global IPO underwriters in terms of dollar volume of new equity. So new equities that come up, for firms are written by these banks here. Obviously, JP Morgan is US-based, but Deutsche Bank is German. Citibank is US-based. Barclays is UK. Bank of America, Merrill Lynch, that is a merge because it was Bank of America and then Merrill Lynch was separate. They all merged. This is US-based. Morgan Stanley is US-based. Goldman Sachs is again US-based. Credit Suisse is European-based. UBS is again European-based. HSBC is Hong Kong and European Union-based. So, and here's just to give you a reference on biggest IPOs. For example, Facebook had the U.S. proceeds of these $1 million. So you can see that a large amount is being raised. And again, going back to our earlier discussion, this money is coming from savers. And imagine if, for example, this money had to be raised by this firm alone directly, it wouldn't have been possible because now it's coming from intermediary who are experts in issuing IPOs and reaching out to investors, and that makes it easier for these companies to focus on what they are doing at best, and they continue building their products and basically not worry about raising funds for expansion and so forth. So coming to some of the topics that were not on the slides, but it's important to discuss, is to look at the aspect of the markets, types of markets. We got the spot markets versus futures market. Spot market is a market in which assets are bought or sold for on-the-spot delivery. In case of future markets, the market in which participants agree today to buy or sell an asset at a future date. So, for example, spot market would be you enter the market, you enter into transaction, you buy or sell, and you exit. In case of futures market, you enter the market to purchase a security or sell a security for a delivery or purchase at a future point of time. So basically, basing on your speculation of the stock price or any commodity or asset going up or down, and that basically provides a leading price levels for any asset. So that, again, we'll be discussing all these in detail. Money markets, I already explained. Funds are borrowed for or loaned for short periods, less than a year. Capital markets, financial markets for stocks and intermediate or long-term debt, which is 1 year or longer. Primary market, markets in which corporations raise capital by issuing new securities for the very first time. So when the stocks are issued for the very first time, they are done in primary market, for example, the IPO. And once they have been issued, the stocks, and they're traded afterwards, they're done in secondary markets, which would be the markets in which securities and other financial assets are traded among investors after they have been issued by corporations. Now, derivatives, we've already discussed that in the previous chapter. Just to kind of give you an example of we discussed about investment bank, which will be an organization that underwrites and distributes new investment securities and help business obtain financing, like I mentioned about, the IPO. Commercial bank, a traditional department store of finance, serving a variety of savers and borrowers, normally large banks, commercial banks, for example, JP Morgan Chase, Bank of America. They do not just the traditional borrowing and saving. They also have expanded into investment securities. For example, you can have a brokerage account, and you can also open retirement accounts, various types of retirement accounts, college fund account, and so forth. So these banks, commercial banks, would allow you to do all those services. They also hold, the clients, especially for customers who are commercial enterprises. For example, if they have to deal with foreign companies, they have to trade in foreign currencies, these commercial banks will do that. If these companies require bankers' acceptances, they'll do that. If they want to open a certificate of deposit, negotiable certificate of deposit, these commercial banks have the capacity to do it. Let's say, Coca-Cola, which has almost, operations in almost all countries of the world, and they need, let's say, currencies of 50, 60 different countries that they typically would trade or be transacting on a daily basis, a commercial bank would definitely do it because they deal, or must have operations, or typically will have operations in a lot of countries. They also do or help with advising when you're moving out to new countries. For example, they have offices, expertise in other countries, so they'll help settle businesses there. So they're adding on for various services. Financial Services Corporation is a firm that offers a wide range of financial services, including investment banking, brokerage, operations, insurance, and commercial banking. Mutual funds, organization that pool investor funds to purchase financial instruments and thus reduce risk through diversification. Again, we'll discuss that in detail when we come to the chapter of securities. Mutual funds that invest in short-term, low-risk securities and allow investors to write checks against their accounts are money market funds. The over-the-counter market is a large collection of brokers and dealers connected electronically by telephone and computers that provide for trading in unlisted securities. So, for example, in the case where sometimes the firms that have not done well and they do not meet the typical market capitalization threshold for the stock exchange, then they're delisted. But again, the companies would still have stocks, so they still have to be traded. So if they're not being traded officially on the stock exchange, then they can be traded on the over-the-counter market. The dealer market, as I explained, includes all facilities that are needed to conduct securities transaction not conducted on physical location exchanges. So dealers who make the market, who actually do the buying and selling in the market, they would be connected through network, computer network. And so when any order is placed for purchase or selling, the computers try to automatically match those orders in this dealer connected network. So that brings us to the end of discussion on chapter 2, and I would encourage you to also reference chapter 2 in the textbook, because there are some other minute details or introductory details, which I will repeat when we come to those chapters, that you may want to also glance or reference through as we proceed on to the next chapter. Thank you for listening, and I'll be seeing you soon in the next chapter.